I'm Chris Beecham and welcome to Charting the Market on IG Live. This morning it is of course a bit of a day of not very much happening in markets because of US Independence Day. That takes away a lot of liquidity, a lot of activity out of markets, to say nothing of no US data this afternoon. So there isn't very much to move markets from this point on for the rest of the session. That said, of course, you have had overnight the RBA decision at which they decided to keep rates unchanged at 4.1%, arguing that inflation in Australia seems to have passed its peak. Although, as ever with central banks, there was a sting in the tail. They left open the possibility of another 25 basis point hike later in the year. We also had further worries about the potential for intervention in the FX markets in Japan. And the continuing weakness of the yen has undoubtedly got the interest of the Ministry of Finance in Tokyo, and so that will be something to watch out for markets, even if there isn't anything else. Last week we had a warning from the Ministry of Finance that they were watching the strength or the weakness of the currency, and so it's undoubtedly the case that they are considering some kind of intervention. But with US markets out of the picture, we face a fairly lackluster session for European markets. US markets are open until about 1 o'clock on the IG platform. They reopen later on this afternoon. Starting with the indices, beginning with the FTSE 100, currently trading at 75.39. And you can see here how the index has done its best to recover over the past few days, really. Last week's low around 74.50, indeed just below that really, was met by buying pressure, and that mirrored what we saw at the beginning of January, really, with the index hitting trendline support in that case and then rallying for a few days. We then dropped back again, but 74.50 proved to be, if you like, a line in the sand for the buyers, and they have managed to claw back some lost ground. They are, however, below the 200-day moving average still for this index, which of course marks a very impressive turnaround from the very beginning of the year when you had such a strong performance for the FTSE 100 index, essentially having gone nowhere now since the beginning of the year, unchanged on the year, more or less. If it does need to break trendline resistance around 75.90, if it's to be with a meaningful chance of move to the upside, if it does go back above there, the next area to watch then becomes this area around 76.50, which is where the gains at the end of May and into the first half of June stall. So those are your levels to watch to the upside. And for the sellers, they have seen obviously a short-term bounce, but if it goes back below 74.50, that is the kind of move they'd be looking for to open the path towards that 7,300 low that was so important in March and indeed back into December of last year. The FTSE finds itself really in a bit of a no man's land, I think, below the 200-day, below the 50 and 100-day moving average. So unlike other markets which are in very clear uptrends, this one, it's very much harder to call this one particularly bullish at this point in time. Certainly the price action since the second half of April militates against that view. Turning to the DAX, this one continues to consolidate more than anything else. We're still very, very close to these one-year highs, these record highs for the DAX we just managed to eke out during the course of June. But it's certainly not heading lower at this point in time. Interestingly, last week saw the index go back to 15,700, which, if you remember from April, was a big area of support, and into May as well. The index showed a distinct reluctance to go below that level, having found it as resistance in the early part of March. It then crossed the line and has showed determination, I think, to stay above that level. So while we did have a rally into the close on Friday, with the end of the week, the quarter, the month, the first half, it has just obviously come off the last couple of days, including this morning, although much of that is down to the US being out for today. So just moving sideways in the DAX, but until it goes back below 15,700, it's really still more in consolidation mode, and move to the upside would take out 16,300 and potentially put us on course for another move into fresh record high territory. Not impossible to imagine, really, of course. And this is where I think the way charts are set up, it tends to look as if we can't go much higher than that. We look back naturally and see how far the DAX has come. But if this is the beginning of the next bull market or a longer term move higher, there is plenty of room to the upside for this to make a move in the direction of 17,000 higher over the course of time. Something to bear in mind as we look at these charts. And while it is a US holiday and US markets will be closed this afternoon, they are still open on the IG platform until about 1:30. You find the Dow back at 34,000, just below this 34,500 high from the second half of June, and indeed that was a big level back into February and earlier too. It has done a better performance, really, this index, lagging behind things like the Nasdaq and the S&P because of the tech component. So essentially, it, even like the FTSE 100, is moving sideways and has done since December. Broader consolidation is probably the best way to describe what we're seeing in the Dow. No real appetite yet to move on above 34,500, but something perhaps to bear in mind. For example, if the rally sees broadening participation, more sectors joining in rather than just tech and a few others, the Dow is perhaps where you'll see that. And if we see it move above 34,500, you've got a bit more upside towards the December high at 35,000. And maybe it sees further gains in the direction of these record highs from the beginning of 2020. There's only 2,700 points, right? That sounds like a lot, but for the Dow, if it really wants to do that, it could do that in a very short space of time. So do just be aware of that possibility. For the sellers, if it's going to start heading lower, you want to see a break of trendline support from the May low. So back below 34,000 would be a negative indication, and certainly back below 33,600 would reinforce that impression as well. FX markets quiet, as you might expect, with the dollar out of action more or less today. Of course, it is still being traded in global markets, but not to the same extent as it would be on a normal day, what with the US in a holiday. So looking at euro dollar, back to 109, really, just easing back to the 50-day moving average after its recovery from the end of June. Sorry, the beginning of June, we're down at 107. The price then rallied. I think there's a lot of concern that maybe that's come too far, too fast in the short term, really. The Fed doing its best to talk up the hawkish element of its policy, although the market still doesn't really seem to believe it, interestingly enough. So just seeing intraday weakness over the last 2 weeks or so, capping that trendline resistance. Break above 109 would be the development I think bulls will be looking for, to say that that consolidation from the late June high has run its course, and perhaps we've got the strength now to move on towards 111 or so. Certainly at the moment, trendline support from the lows of June is continuing to hold. So back below 108, and that might start to dent that view as well. It's just we've got to move back down in the direction of 106.35. The pound against the dollar, similar picture, really. Rally in June and then pull back over the past couple of weeks, really, in the wake of that Bank of England rate decision. But still holding on, I think, with the gains today. It's again shaping up for another attempt to break out of trendline resistance and push on towards 128 and higher. Still firmly in an uptrend here. The price above the 50-day moving average, above the 100-day moving average, and above the 200-day, and all three of those are moving higher. So it's very hard to argue with a bearish view in the short term here, really. If it has topped, it certainly doesn't look like it at this point in time. So I think it's more likely that we see this breakout perhaps in coming days back above 127.50 and onwards from there. Otherwise, the reversal back below 126 might bring perhaps a test of the 100-day moving average into play. If we get perhaps some more cautious commentary of the Bank of England, which seems unlikely given the way inflation and mortgages continue to rise, I think it's likely that we'll just see the Bank of England continue to reiterate the need for more rate hikes, which would arguably put the pound on the front foot against the US dollar. But it's the yen where things really could start to look interesting very quickly. And I thought the stress there is on could, because the weakness in the yen, the strength in the dollar has undoubtedly aroused the interest in the Japanese Ministry of Finance. And it could be that we see some intervention at some point where they begin buying the yen to prop it up against the dollar and cause quite a bit of reversal. But given the size of the move from 128 to 145 over the year so far, it is undoubtedly the kind of thing that will have them wondering at what point they need to intervene. So if you are trading dollar yen, you do need to bear that one in mind. It might not happen anytime soon, but I think it's definitely a possibility at this point in time. And if you are therefore long dollar yen, you could expect to see this move dramatically to the downside. That said, it does look very overextended in the short term. If you look at that, the distance from the 50-day moving average around about 3.5% or 500 points here. So it could move dramatically back down towards 139 and still be in an uptrend. Just taking a bit of a knock, so that's definitely something to watch in the short term. Even if there is no intervention, it probably does look overextended, and maybe you get some consolidation similar to what we saw at the end of May and into the beginning of June. So do just watch out for that one, really. Trying to chase it up here after what's been quite a big move for dollar yen over the past month might just be not the most prudent move, if I put it that way. Perhaps you're a bit late to the party. Essentially, it's already enjoyed a big move, but still, more or less, of course, you've got this golden cross, they like to call it, the 50-day moving average crossing above the 200-day moving average. So while that isn't a buy signal in and of itself, really, because it just reflects the size of the move we've had, it certainly does send a message that the dollar has firmly recovered against the yen and seems set on moving higher over the medium term. So perhaps that means, again, even more so than has been the case over the past 2 or 3 months, perhaps dips are there to be bought rather than rallies to be sold. Then finally, turning to commodity prices, gold continues to really be in a broader downward move over the past 2 months. Although, as we can see here on this chart, we are back at the 1930 level. We've clawed our way back higher from the lows of last Thursday, down below 1900. But as we've been flagging, it's this trendline resistance from early June that could be a bit of a problem. If it can't get back above that, then we've got maybe another turn to the downside coming through, and the sellers might look to push this one back to 1900 and perhaps back to the 200-day moving average as well. So at the moment, the gold also finds itself in sort of a no man's land between the declining 50 and the rising 200-day moving average. Quite hard to sort of call this one at the moment. It still is more or less in an uptrend. If you look at the move from October, November, and to now, excuse me, but it is really quite difficult to call, I think, at this point in time. It certainly isn't obvious that it's going to revive. Back above 1917 might have an easier time of suggesting that now it's in an upward move. But of course, by that point, you've already seen it rally. So it's a tough one to argue, but certainly anything below 1930 might still argue that we've got another leg lower for gold prices. And then finally, crude oil. Production cuts yesterday from Russia and a decision to keep production unchanged by Saudi Arabia. Tiny bounce in the oil price, hits the 50-day moving average, drops back again. So really, it hasn't really changed the outlook here. So long as the price is below the 50-day moving average, it really is hard to muster up much of a bullish view, unless you're going to go to sort of a longer-term view and argue that maybe we've bottomed out here and we've got signs of recovery. But for the daily chart, at least, sellers do just seem to have the upper hand. It's just waiting for the next leg lower that could bring us back towards 6,700 or even back down towards 64. Otherwise, if we do get above the 50-day, that will be a good first step. But then you've got a lot of hurdles across, i.e. it's got to get back above 74 and then perhaps be with a chance of heading back towards the 200-day moving average. But recession fears continue to dog crude oil really at the moment, and it's just a concern that whatever they do in terms of production, demand continues to get weaker and just puts downward pressure on the price, and not much change in that view at this point in time really. So US markets, of course, no cash open for the US. I know 2:30 open for US markets this afternoon UK time. It is still available on the IG platform until about 1:30, and then it's closed until the late afternoon and reopens again as normal. So do watch out for that. Otherwise, it's a very quiet day for European markets. No data this afternoon expected. We're just seeing a bit of a mixed trading across European indices with not much direction really. Normal service is expected to be resumed obviously tomorrow when you have got Fed minutes to kick in, so do watch out for those. That's it from me. Thank you for joining us. We'll be back as normal tomorrow at 10:30.